Good morning or good afternoon, everyone. Today, I am going to talk about a topic that affects millions of people around the world, whether they realize it or not: the stock market. Many people think the stock market is only for wealthy investors or financial experts. Others believe it is just a place where people gamble with money. However, the truth is very different. The stock market is one of the most important parts of the global economy. It helps businesses grow, creates jobs, builds wealth for individuals, and supports economic development. So, what exactly is the stock market? The stock market is a marketplace where people buy and sell shares of publicly listed companies. A share, also called a stock, represents a small piece of ownership in a company. When you own shares of a company, you become one of its shareholders. Although your ownership may be very small, you still own a part of that company and may benefit from its success. Imagine a company wants to expand its business. It may need money to build new factories, develop new products, hire more employees, or enter new markets. Instead of borrowing all the money from banks, the company can sell ownership shares to the public through the stock market. Investors buy these shares because they believe the company will grow and become more valuable in the future. For example, if a company is divided into 1 million shares and you buy 1,000 shares, you own a small percentage of that company. If the company performs well and earns more profits, the value of your shares may increase. Some companies also reward shareholders by paying dividends, which are portions of the company's profits distributed to investors. The stock market serves two main purposes. First, it allows companies to raise capital for growth and expansion. Second, it provides investors with opportunities to grow their wealth by investing in successful businesses. Now, let's understand how the stock market works. Every day, millions of buyers and sellers participate in the market. Buyers place orders to purchase shares, while sellers offer shares for sale. The price of a stock changes constantly based on supply and demand. If many investors want to buy a stock, its price usually rises. If many investors want to sell it, the price usually falls. Several factors influence stock prices. These include a company's financial performance, economic conditions, interest rates, inflation, political events, government policies, technological innovations, and even investor emotions, such as fear and optimism. For example, if a company reports strong profits and announces exciting future plans, investors may become more confident and buy its shares, causing the stock price to increase. On the other hand, if the company experiences losses or faces unexpected challenges, investors may sell their shares, leading to a decline in the stock price. There are many participants in the stock market. Individual investors are ordinary people who invest their personal savings. Institutional investors include banks, pension funds, insurance companies, and mutual funds that invest large amounts of money on behalf of their clients. Stockbrokers act as intermediaries who help investors buy and sell stocks. Through stock exchanges, a stock exchange is an organized marketplace where stocks are traded. It ensures that transactions are conducted fairly, transparently, and efficiently. Modern stock exchanges use advanced electronic trading systems that process thousands of transactions every second. Many countries have their own stock exchanges. These exchanges play an essential role in supporting economic growth and attracting investment. One of the biggest advantages of investing in the stock market is the potential for long-term wealth creation. Historically, stock markets have provided higher average returns than many other investment options, such as savings accounts or fixed deposits. Although stock prices fluctuate in the short term, many successful companies have increased significantly in value over long periods. Another benefit is diversification. Investors can spread their money across different companies and industries, instead of putting all their savings into one investment. Diversification helps reduce overall investment risk, because if one company performs poorly, gains from other investments may offset those losses. The stock market also provides liquidity. Liquidity means investors can usually buy or sell shares quickly whenever the market is open. This flexibility makes stocks more attractive than investments that require long waiting periods before money can be withdrawn. Despite these advantages, investing in the stock market also involves risks. Stock prices can rise and fall unexpectedly. Economic recessions, political instability, natural disasters, global conflicts, or poor company performance can cause significant losses. Therefore, investors should never expect guaranteed profits. One common mistake beginners make is investing based on rumors or emotions. Some people buy stocks simply because everyone else is buying them. Others panic and sell during market declines. Successful investors usually make decisions based on careful research, financial analysis, and long-term goals rather than short-term emotions. Before investing, it is important to understand a company's business model, financial statements, competitive advantages, management quality, and future growth prospects. Investors should also consider their own financial goals, risk tolerance, and investment time horizon. Long-term investing is generally considered safer than trying to make quick profits through frequent trading. Many experienced investors believe that patience and discipline are key to achieving long-term success in the stock market. The stock market also reflects the overall health of the economy. When businesses are growing, employment is increasing, and consumer spending is strong, stock markets often perform well. During economic downturns, stock markets may decline because companies earn lower profits and investors become more cautious. Technology has transformed investing dramatically. Today, people can buy and sell stocks using smartphones and online trading platforms within seconds. Investors have easy access to financial news, company reports, educational resources, and market data. This has made investing more accessible than ever before. However, easy access also creates challenges. Social media, online influencers, and unverified investment tips can spread misinformation quickly. Investors should always verify information using reliable sources before making financial decisions. It is also important to understand that investing is different from gambling. Gambling depends mainly on chance, while investing involves purchasing ownership in real businesses that produce goods and services, earn profits, and create economic value. Although investing carries risk, informed investment decisions are based on research, analysis, and long-term expectations rather than pure luck. Many famous investors emphasize the importance of continuous learning. Financial markets change constantly as economies evolve, new technologies emerge, and consumer preferences shift. Investors who continue learning and adapting are generally better prepared to make informed decisions. Financial education should begin early. Understanding basic concepts such as saving, budgeting, investing, compound growth, and risk management helps people make smarter financial decisions throughout their lives. Even individuals who never become active investors benefit from understanding how financial markets influence employment, retirement savings, and economic growth. Another important concept is compound growth. When investment returns are reinvested, future returns are earned not only on the original investment, but also on previous gains. Over many years, compounding can significantly increase wealth. This is one reason why starting to invest early can make a substantial difference. Responsible investing is becoming increasingly popular. Many investors now consider environmental, social, and governance factors when selecting companies. They prefer businesses that treat employees fairly, protect the environment, and maintain ethical business practices. This approach allows investors to seek financial returns while supporting positive social impact. In conclusion, the stock market is much more than a place where shares are bought and sold. It is a powerful financial system that connects businesses seeking capital with investors seeking opportunities to grow their wealth. It supports innovation, creates employment, strengthens economies, and helps individuals achieve long-term financial goals. Although investing involves risks, knowledge, patience, diversification, and disciplined decision-making can improve the chances of long-term success. Understanding the stock market is an essential financial skill in today's world because it affects businesses, governments, retirement funds, and the financial well-being of millions of people. I hope today's discussion has helped you understand what the stock market is, how it works, why it is important, and how responsible investing can contribute to both personal financial growth and economic development.